Think about this for a moment. For the first 137 years of its existence, the United States of America, the nation that would eventually become the world's largest economy, operated without a permanent central bank. No Federal Reserve, no singular authority controlling the money supply, no lender of last resort standing behind the entire financial system ready to catch it when it fell. And yet, during that same stretch of time, America went from a fragile collection of war-torn colonies drowning in debt to the most powerful industrial force on Earth. So how did it work? How did the economy survive without the institution we now consider absolutely essential to modern finance? The answer is far stranger, far messier, and far more revealing than most people realize. Because America didn't simply coast through those years on luck and hard work. It lurched from crisis to crisis, from boom to bust, from stability to absolute chaos over and over again. The country experimented with central banks, killed them, tried something different, watched it collapse, and then tried again. Along the way, titans of industry, street-level conmen, furious presidents, secretive bankers, and entire communities of ordinary people were swept up in a financial drama that shaped not just the American economy, but the global order we live in today. And the story of how America finally got its central bank, the Federal Reserve in 1913, is one of the most extraordinary, conspiratorial, and consequential episodes in the history of money itself. Let's rewind to the true starting point of this story, back before America even had a working currency, let alone anything resembling a central banking authority. When the colonies broke away from Britain in 1776, they inherited a problem arguably scarier than the redcoats marching toward them, money or rather, the complete absence of it. The Continental Congress needed to bankroll an entire revolution, yet it possessed no taxing authority, no gold reserves, no financial machinery of any kind to draw on. So it did what cash-strapped governments have done throughout history when cornered. It fired up the printing press. Between 1775 and 1779, Congress pushed roughly $241.5 million worth of paper notes, called Continentals, into circulation. These carried nothing behind them except a hazy assurance that the fledgling nation would eventually make good on them someday. Initially, people went along with it, but as the fighting stretched on and Congress kept cranking out more and more paper, the currency's value simply disintegrated. By 1780, a continental dollar was worth less than a single penny relative to its printed face value. The saying "not worth a continental" entered everyday speech as shorthand for anything utterly valueless. Soldiers who had bled for independence found themselves paid in money that couldn't buy them a loaf of bread. Farmers stopped accepting the rapidly crumbling paper altogether. An entire town slid backward into straight barter just to keep commerce moving. This was the financial soil the United States sprouted from, a nation whose very first taste of government-issued currency was a full-blown catastrophe. And that early trauma would color every single argument about banking and money for generations afterward. Americans came out of that experience with a genuine, gut-level terror of centralized monetary authority. And honestly, who could blame them? They had just watched their own government obliterate the value of their savings with nothing more than a printing press. That fear didn't fade, it hardened into one of the most durable political forces in the country's history. But one man looked at this wreckage and concluded that the only path forward was to construct a real financial architecture from the ground up. That man was Alexander Hamilton. He hadn't been born into any kind of American privilege. He arrived as an orphaned immigrant from the Caribbean. A young man who fought his way into the revolutionary elite purely through raw talent and unrelenting drive. When George Washington tapped him to become the nation's very first Treasury Secretary in 1789, Hamilton inherited an absolute mess. The federal government was carrying roughly $54 million in wartime debt, with individual states owing another $25 million on top of that. The currency was in tatters, and foreign lenders had little confidence this experimental democracy would even survive long enough to settle its accounts. Hamilton's fix was bold and it was polarizing. He proposed that the federal government absorb every state's wartime debt, roll it all into one consolidated national obligation, and then establish a national bank to oversee the entire arrangement. This institution, he argued, would anchor the currency, gather tax revenue, extend credit to the government itself, and safeguard federal funds. He drew inspiration directly from the Bank of England, the very institution that had helped elevate Britain from a mid-tier European power into a sprawling global empire. To Hamilton, this wasn't simply a financial instrument. He described it as an institution of the greatest political consequence to the state. It would bind the country's wealthiest merchants and financiers directly to the success of the federal government, since a national collapse would render their bank investments worthless right alongside it. Clever, undeniably, but also deeply unsettling to a huge swath of the population. Opposition rallied around two towering figures of the era, Thomas Jefferson and James Madison. Jefferson, the great defender of agrarian democracy, viewed Hamilton's bank scheme as a Trojan horse smuggling in northern financial power. He worried it would create a privileged monopoly favoring merchants, creditors, and bankers at the direct expense of the farmers and planters who made up the backbone of the young economy. He also insisted the Constitution granted Congress no explicit authority to charter such an institution, and if the government could simply invent new powers like this one, he warned, then the entire premise of a government limited to specific enumerated authority would collapse into meaninglessness. Madison stood right alongside him, cautioning that the bank would funnel wealth and influence toward a narrow, privileged class. The argument grew so heated, it split American politics into its first genuine ideological rift. Hamilton's camp, the Federalists, believed government needed a strong, active hand in shaping the economy. Jefferson's Democratic Republicans championed states' rights, minimal federal involvement, and a deep, abiding suspicion of concentrated financial muscle. This wasn't merely a policy squabble. It was a fight over what kind of country America was actually going to become. Hamilton ultimately prevailed. He persuaded Washington that the Constitution's necessary and proper clause implicitly authorized Congress to charter a national bank. Washington put his signature on the bill on February 25, 1791, and the first Bank of the United States opened for business in Philadelphia later that same year. Capitalized at $10 million, an eye-watering sum for the era that instantly made it the largest corporate entity anywhere in the country. The federal government held a fifth of its stock with private investors, including a notable share of foreign shareholders, a detail that made plenty of Americans uneasy, owning the remainder. For 2 full decades, the first bank essentially delivered on Hamilton's promises. It steadied the currency, managed federal finances competently, extended credit that fueled commerce, and helped smooth interstate trade. It even functioned as an informal watchdog over state-chartered banks, periodically presenting their notes for redemption in hard coin, a practice that forced those banks to keep adequate reserves rather than flooding the market with reckless amounts of unbacked paper. The broader economy expanded steadily. Foreign creditors regained genuine confidence in the American experiment. The national debt came under control by nearly every practical measure. The first bank was a success story, but success on paper doesn't guarantee political survival. By 1811, when the bank's 20-year charter came up for renewal, the political terrain had shifted dramatically. Hamilton himself was long dead, killed in his infamous duel with Aaron Burr back in 1804. Jefferson's party now firmly controlled the government. The number of competing state-chartered banks had multiplied enormously, and those institutions deeply resented the first bank's regulatory oversight and its built-in competitive edge. Foreign ownership of the bank's stock, which had climbed to roughly 70%, became a devastatingly effective political attack line. Critics argued British and Dutch investors were quietly profiting off American commerce at ordinary citizens' expense. When the renewal vote reached Congress, it failed by a single vote in the Senate, and the First Bank of the United States quietly shut its doors. For the first time, the country had to discover firsthand what an economy without any national banking anchor actually looked like. The answer arrived quickly, and it wasn't pretty, with no first bank left to discipline the behavior of state banks. Their numbers exploded almost overnight. In 1811, roughly 88 state-chartered banks operated across the country. By 1816, that figure had ballooned past 246. Plenty of these institutions were thinly capitalized and barely regulated. They printed staggering volumes of their own currency, most of it trading at inconsistent discounts depending on distance from the issuing bank and how much confidence the market placed in its ability to actually redeem notes for hard metal on demand. The resulting confusion was extraordinary. A dollar note issued by a Boston bank might fetch 90 cents in New York and shrink to barely 60 cents by the time it reached Ohio. Merchants had to carry counterfeit detection guides and discount tables just to conduct routine transactions. Fraud proliferated wildly. Some estimates suggest roughly a third of all paper currency circulating during the roughest stretches was outright counterfeit. Then came the War of 1812, and the cracks turned into fault lines. The federal government needed massive borrowing to fund the conflict with Britain, but with no national bank to coordinate the effort, the Treasury struggled badly to raise the necessary funds. It ended up issuing bonds at steep discounts and borrowing from state banks at punishing rates. By the war's conclusion, the Treasury was teetering on the edge of insolvency, and the entire financial system was in visible disarray. The lesson landed hard, whatever philosophical objections people harbored toward a national bank. The practical experience of waging a major war, without one had been nearly catastrophic. So in 1816, barely 5 years after letting the first bank lapse, Congress chartered the Second Bank of the United States, capitalized at $35 million under a fresh 20-year charter. Headquartered once again in Philadelphia, its structure closely mirrored its predecessor. The federal government held a fifth of the stock, appointed a fifth of the directors, and parked its funds there. The Second Bank stumbled badly out of the gate. Early management was both incompetent and corrupt, doling out enormous non-performing loans to insiders and political cronies. The institution helped inflate a speculative land boom that then imploded catastrophically, triggering the Panic of 1819, the country's first genuinely major financial crisis. Banks collapsed nationwide. Foreclosures swept through farming communities. Unemployment spiked sharply. The public pinned the blame squarely on the Second Bank, and not without justification. But then the story pivoted. In 1823, a formidable and sharp-minded financier named Nicholas Biddle took the reins as bank president. And he was practically the opposite of his predecessors, disciplined, forward-thinking, and remarkably fluent in the mechanics of monetary policy. Under Biddle, the Second Bank evolved into something that functioned strikingly like a modern central bank. He managed the broader money supply by expanding or tightening credit as conditions demanded. He maintained currency uniformity by accepting state banknotes at full value and periodically presenting them for redemption, whenever they multiplied too aggressively. He delivered efficient fiscal services to the government and even helped wipe out the entire national debt by 1835, the only time in American history that has ever happened. By the late 1820s, the Second Bank had become one of the most formidable financial institutions on the planet. Its notes carried full confidence anywhere in the country. Commerce flourished from Boston all the way out to the expanding western frontier. State banks and businesses alike had benefited from tens of millions in credit. The economy hummed along nicely. And then Andrew Jackson showed up. Elected president in 1828 as the self-styled champion of the ordinary American, Jackson was a frontier war hero who despised the Eastern financial establishment down to his bones. Earlier in his career, he'd been personally burned by a financial speculation gone bad, and it left him with a visceral, almost obsessive distrust of banks, paper currency, and any institution he believed concentrated economic power in the hands of a privileged few. To Jackson, the Second Bank wasn't a useful tool. It was a monster, a many-headed beast enriching wealthy stockholders and foreign investors while grinding down ordinary farmers, laborers, and small business owners. He viewed Biddle as a dangerous aristocrat wielding unaccountable authority over the nation's finances. That the bank was, by nearly every measure, performing extremely well didn't matter to Jackson in the slightest. For him, this was purely a matter of principle, and the principle was simple. No private institution should hold that much power over the economic lives of a free citizenry. The showdown between Jackson and Biddle became one of the most theatrical political confrontations of the era. In 1832, Jackson's congressional opponents, led by Senator Henry Clay and Senator Daniel Webster, rammed through a bill renewing the bank's charter 4 years ahead of schedule, gambling that Jackson wouldn't risk vetoing something so popular during an election year. They gambled wrong. Jackson struck down the recharter with one of the most forceful and emotionally charged presidential statements ever issued, branding the bank unauthorized by the Constitution, corrosive to states' rights, and a genuine threat to the liberties of ordinary citizens. He even flatly rejected the Supreme Court's earlier ruling in McCulloch v. Maryland, which had already affirmed the bank's constitutionality, insisting that as president he retained the right to interpret the Constitution on his own terms. The veto was unprecedented in both scope and tone. Jackson then made the bank's fate the centerpiece of the 1832 election, framing the entire contest as a battle between ordinary Americans and what he called the money power. He won decisively and treated the landslide as a direct mandate from the public. Jackson pressed his advantage further, ordering all federal deposits pulled from the Second Bank and scattered across dozens of state-chartered institutions his critics mockingly dubbed pet banks Biddle, fired back by sharply restricting the bank's lending, deliberately engineering a credit crunch, gambling that enough economic pain would pressure Congress into overriding Jackson's veto. It was an extraordinarily reckless bet, and it blew up in his face. Rather than turning public opinion against Jackson, Biddle's financial retaliation only confirmed every warning Jackson had made about the bank's dangerous concentration of power. Here was a single unelected banker deliberately plunging the country into hardship purely to protect his own institution. When the Second Bank's charter finally expired in 1836, Congress let it die. America had now killed off 2 central banks in succession, and this time no replacement would emerge for another 77 years. What followed became one of the strangest, most turbulent chapters in the entire history of American finance, a genuine real-world test of whether a modern economy could actually operate without any central monetary authority overseeing it. The stretch running from roughly 1837 through 1863 became known as the Free Banking Era, and the label itself hints at the underlying philosophy. In many states, virtually anyone who could scrape together modest capital and satisfy some minimal registration requirements could open a bank. There was no federal oversight of banking whatsoever. Every state set its own rules, and in some cases, barely any rules existed at all. Each of these institutions could print its own paper currency, backed by whatever assets it held, typically a mix of state bonds, mortgages, or actual gold and silver coin. The result was a genuine explosion of financial creativity, financial disorder, and more than occasionally, financial fraud on a spectacular scale. At any given moment during this era, hundreds, sometimes thousands, of distinct banknotes circulated simultaneously across the country, each with its own design, denomination, and reliability. A traveler heading from New York to Illinois might pass through a dozen different regional currencies, each trading at a different discount or premium depending on the issuing bank's reputation and how far it was from home base. Merchants leaned on published guides, banknote reporters, just to keep track of what any given piece of paper was actually worth, and even armed with those guides, doing business remained a nightmare of friction, confusion, and risk. And then there were the wildcat banks, the most notorious symbol of this hands-off approach to finance. The nickname supposedly traces back to the practice of deliberately setting up banks in remote, barely accessible locations where actual wildcats roamed, specifically to make it as inconvenient as possible for note holders to physically show up demanding redemption in gold or silver. Michigan's experience in 1837 and 1838 became the textbook cautionary tale. The state had passed one of the earliest free banking laws, and within months dozens of new banks sprang up almost overnight. Some were legitimate operations, plenty weren't. State inspectors were technically supposed to verify each bank's gold and silver reserves, but they were overwhelmed and chronically underfunded. Stories spread of a single chest of coins being shuttled from bank to bank, always staying one step ahead of the examiners, creating the illusion that every institution held adequate reserves, when in reality, none of them actually did. Some banks existed purely on paper, no physical office, no staff, no genuine intention of ever redeeming the currency they printed. They'd flood the market with notes, let them circulate widely, and then simply vanish, leaving holders clutching worthless scraps. It's worth noting, though, that the free banking era wasn't the unmitigated disaster its worst reputation might suggest. More recent historical research indicates the wildcat problem was concentrated in a handful of loosely regulated states, Michigan chief among them, while plenty of free banks, particularly in states like New York, actually operated with reasonable competence. Failure rates were high. Somewhere in the range of 50 to 60% of all free banks eventually closed, but many of those closures were orderly affairs, with note holders recovering most or all of their money in the end. Messy, certainly, but not uniformly catastrophic. That said, the periodic full-blown panics were entirely real and entirely devastating. America weathered major financial crises in 1819, 1837, 1857, 1873, 1893, and 1907. Each one followed a remarkably consistent script, a stretch of expansion fueled by easy credit and speculation, followed by a sudden collapse of confidence, a mad scramble to withdraw deposits and redeem notes, a cascade of bank failures, a sharp credit contraction, and finally a brutal economic downturn that threw millions out of work and wiped out fortunes large and small. Without a central authority capable of stepping in as a lender of last resort to inject liquidity when confidence evaporated, there was no institutional circuit breaker to halt the collapse. The whole system leaned instead on the informal cooperation of individual banks, clearinghouse associations, and occasionally the personal intervention of extraordinarily wealthy private citizens to stop the bleeding. In its worst moments, it was an economy held together with little more than improvisation and hope. The Civil War forced yet another sweeping overhaul of American finance. In 1861, the Union confronted essentially the same predicament the Continental Congress had faced generations earlier, an urgent need to finance a massive war effort with no straightforward mechanism to do it. Treasury Secretary Salmon Chase engineered a solution that would reshape American banking for the next half-century. First, Congress authorized roughly $450 million in paper currency known as greenbacks, named for the distinctive green ink printed on their reverse side. These represented the first genuinely national paper currency, declared legal tender for every debt, public and private. Though notably unbacked by gold or silver, their only real backing was the full faith and credit of a government that at the time was fighting a war. It wasn't guaranteed to win. Inflation followed much as it had during the Revolution, though somewhat less severely at their lowest point. Greenbacks traded around 35 cents against $1 in gold. The more durable innovation, though, arrived through the National Banking Acts of 1863 and 1864. These laws established a system of federally chartered banks empowered to issue a new uniform national currency, but only after first purchasing U.S. government bonds to serve as backing. From the government's perspective, this was a masterstroke. It manufactured a massive captive market for war bonds, guaranteeing continued borrowing at favorable rates while also delivering a far more consistent currency, since every national banknote now looked alike and rested on identical collateral. To finish off the old chaotic patchwork, Congress imposed a punishing 10% tax on any notes issued by state-chartered banks, effectively driving them out of the currency printing business entirely. The national banking system marked a genuine improvement over the disorder of the free banking years, but it still wasn't a central bank. There was no overarching authority managing the broader money supply, no lender of last resort, no built-in mechanism for emergency liquidity during a crisis. The system was rigid by design. The volume of national banknotes in circulation was tied directly to the supply of government bonds, meaning the currency couldn't flexibly expand or contract based on what the actual economy needed. Every autumn, when farmers needed credit to move harvests to market, demand for cash spiked sharply and interest rates lurched painfully upward. Every spring, once the crop-moving season wound down, that excess currency flowed back into New York, fueling Wall Street speculation instead. This seasonal tug-of-war created chronic instability, and it hit farmers across the South and West especially hard, many of whom reasonably concluded the entire financial system had been engineered to benefit Northeastern bankers and industrialists at their direct expense. And so the panics kept coming. 1873, 1884, 1890, 1893. Each one reinforcing the same painful lesson: without a central bank, the American economy remained extraordinarily exposed to financial shocks. Whenever confidence cracked, there was no shock absorber built into the system. Banks would suspend cash payments, locking depositors out of their own money. Businesses collapsed by the thousands, unemployment surged. Entire communities were devastated. Eventually, the storm would pass, confidence would slowly return, and the whole cycle would begin winding up again. It was a pattern of remarkable dynamism paired with equally remarkable fragility, and it simply couldn't hold forever. The breaking point finally arrived in October of 1907. The Panic of 1907 wasn't technically the most severe financial crisis in American history. The depressions of 1873 and 1893 were arguably longer and more punishing. But 1907 carried something those earlier crises lacked: a single, vivid, almost theatrical human drama that made the absurdity of America's financial vulnerabilities impossible for the public to ignore. The spark was a botched attempt to corner the market on United Copper Company stock. A speculator named Augustus Heinze, working alongside an associate named Charles Morse, had been leveraging a network of banks and trust companies to bankroll the scheme. When the corner unraveled, depositors with money tied to institutions linked to Heinze and Morse panicked and rushed to pull their funds. That panic spread rapidly through New York's broader network of trust companies. These trusts represented a particular soft spot in the system. They competed directly with national banks for deposits, but operated under far lighter regulation, held thinner reserves, and weren't members of the New York Clearing House, the private association that coordinated mutual support among the city's major banks. When the Clearing House refused emergency assistance to the Knickerbocker Trust Company, the city's third largest trust, a full-blown run erupted. Depositors formed long, anxious lines outside its doors, desperate to pull their savings before the money vanished entirely. On October 22, 1907, Knickerbocker suspended operations altogether, locking thousands of depositors out of their own funds. The panic threatened to swallow the entire financial system whole, and no government institution possessed either the authority or the resources to intervene. So the burden of rescuing the American economy fell to one man, a 70-year-old financier with a piercing stare and an unmistakable physical presence, the most powerful private banker on the planet, John Pierpont Morgan. When the crisis broke, Morgan happened to be out of town attending a church convention in Richmond, Virginia. He hurried back to New York and converted his private library on Madison Avenue into an impromptu command center. Over the following 3 weeks, Morgan effectively operated as a one-man central bank. He summoned the heads of the city's major banks and trust companies to his library, personally reviewed their financial books, determined which institutions were genuinely solvent and which weren't, and organized emergency funding pools to keep the viable ones standing. He committed enormous sums of his own personal fortune and pressured other wealthy financiers into matching him. He persuaded the Secretary of the Treasury to deposit $25 million in government funds directly into New York banks. He even orchestrated an emergency rescue of a failing brokerage firm to head off a total stock market collapse, a maneuver that required sign-off from President Theodore Roosevelt, a man who had built much of his political career fighting exactly the kind of constant economic expansion. But they had equally shown that without some central authority to coordinate the system and supply emergency liquidity, the entire economy remained brutally exposed to panics, bank runs, and devastating depressions. The Federal Reserve emerged as a negotiated middle ground between these two competing visions, and in many respects, it still functions that way today. Its decentralized architecture, with 12 regional banks answering to a central board in Washington, directly reflects that enduring American unease about concentrated power. Its mandate to pursue maximum employment, stable prices, and moderate long-term interest rates reflects hard lessons absorbed across more than a century of booms and busts. And the endless, ongoing political argument over whether the Fed wields too much authority or too little, whether it serves Wall Street's interests or Main Street's, whether it should be audited, restructured, or scrapped entirely. That argument is a direct descendant of the fight between Hamilton and Jefferson, between Biddle and Jackson, between the bankers huddled on that private island and the populists who never trusted them. There's one more angle to this story worth sitting with. It's tempting to frame the pre-Federal Reserve era as simply a long, dark age of chaos and failure, finally rescued by enlightened reformers who built a proper central bank, but that framing leaves out something important. Across those 137 years without a permanent central bank, the United States underwent the most extraordinary stretch of economic expansion the world had ever witnessed up to that point. The country transformed from a coastal agricultural society of roughly 4 million people into an industrial powerhouse of 92 million, the world's leading producer of steel, oil, and manufactured goods, with a total economic output that eclipsed every European power combined. The railroad networks that stitched an entire continent together, the factories churning out goods at unprecedented scale, the innovations that brought electric light and telephone wires to cities across the country, all of it happened without a Federal Reserve standing behind it. It happened despite the panics, despite the bank failures, despite the tangled patchwork currency systems and the recurring economic catastrophes. None of this suggests the Federal Reserve was somehow unnecessary, far from it. The human toll of those repeated panics was genuinely immense. Millions of families watched their savings evaporate. Whole communities were hollowed out. The relentless boom and bust cycle inflicted suffering that fell disproportionately on those least equipped to absorb it: farmers, laborers, small shopkeepers with no Wall Street connections, and no private banker willing to bail them out when everything came crashing down. The Federal Reserve, for all its imperfections, was explicitly designed to soften that suffering, to smooth out the sharpest edges of the business cycle, and prevent the kind of recurring financial earthquakes that had rattled the country for over 100 years. But the pre-Fed era also demonstrates something genuinely remarkable about the adaptability of economic systems left to their own devices. In the absence of any central authority, Americans developed a striking range of improvised grassroots mechanisms to manage their financial lives. Clearinghouse associations pooled resources and coordinated emergency lending during crises. Merchants built their own informal credit networks. Communities experimented with local currencies and mutual aid arrangements. Private financiers like Morgan occasionally stepped into the breach as makeshift lenders of last resort. These improvised solutions were far from perfect, often inequitable, frequently insufficient, but they also revealed a genuine capacity for bottom-up problem solving that tends to get lost in tidy narratives about top-down institutional reform. The deeper truth running through all of this is that no financial system is ever flawless. Central banks bring welcome stability, but they introduce their own risks too. The risk of runaway inflation, the risk of moral hazard when institutions expect to be rescued regardless of their choices, the risk that monetary policy gets quietly captured by political interests. The absence of a central bank brought real freedom and flexibility, but it also brought devastating instability and the constant, looming danger that the whole system might collapse under its own weight. The history of American banking before 1913 isn't a simple morality tale of failure followed by triumph. It's the story of an ongoing, never fully resolved tension between the desire for economic freedom and the need for economic security, between fear of concentrated power and the recognition that some measure of coordination is essential to keeping a complex modern economy functioning. And that tension hasn't gone anywhere more than a century later. Every debate over whether the Fed should raise or lower interest rates, every argument about bailouts and institutions deemed too big to fail, every call to audit the Fed or rein in its authority, every financial crisis that exposes fresh cracks in the system, all of it echoes straight back to the same foundational questions Hamilton and Jefferson argued over in Washington's cabinet, that Biddle and Jackson fought over on the floor of Congress, that 6 men on a private island in Georgia tried to quietly settle in the fall of 1910. The real question was never simply whether America needed a central bank. The real question has always been and remains who controls the money and in whose interest that power actually operates. Those aren't questions any single piece of legislation can ever fully settle. They're the questions that define the ongoing unfinished project of democratic capitalism itself. If this story changed the way you think about the financial system we all live under, do me a favor and hit that like button. And if you want to stay in the loop on stories like these, the ones that connect the hidden machinery of money and power to the world we see every day, make sure to subscribe and turn on notifications. I'll see you in the next one.